Um, we hear it basically all the time. The warning that artificial intelligence is like this massive danger because it just copies and magnifies all of our human biases.
Right, yeah.
We feed it our flawed history, and it just automates our prejudices at lightning speed. But what if we have that completely backwards? What if AI is actually the only tool powerful enough to erase decades of systemic prejudice?
It is, well, it's a complete paradigm shift, honestly.
Yeah.
And we are looking at a situation where shifting fairness away from being this, annoying compliance afterthought that banks just have to check off a list
Right,
is
exactly.
turning into a massive foundational competitive advantage.
Yeah. So if you are new to the world of fintech or financial technology, this deep dive is absolutely perfect for you. We're unpacking a single, incredibly fascinating source text today called The Architecture of Integrity, Engineering Equity in AI Lending.
Such a great title, too.
It really is. And our mission today is to understand exactly how a fintech company out of Los Angeles called Zest AI is taking ethical design, which, let's be honest, usually sounds like a fluffy PR term.
Yeah, definitely.
And they're turning it into a hardcore mathematical engineering feature.
I approach this topic with a lot of calm enthusiasm,
Hey.
I have to say. Because what we're looking at in this source material, it isn't just like a neat software trick.
Right.
It is a fundamental rewiring of the broader economic landscape. The stakes here are just astronomically high.
Okay, let's unpack this.
Yeah.
Because to really understand how AI fixes the problem, we first need to understand the structural flaw in how money has been lent out for, well, decades.
Yeah.
Legacy credit models, the traditional FICO scores we all stress out about, they actually rely on a remarkably tiny data set. We are talking about just 15 to 20 variables to determine if you get a loan, a mortgage, or a credit card.
Which is wild to think about.
It is. So for you listening, think of a legacy credit score like trying to identify someone from a 15-pixel photograph. It's a pixelated, incredibly incomplete picture of a borrower's true creditworthiness.
And the small number of pixels is really only half the problem there. The other half is what those pixels are actually made of.
Right.
These legacy models were trained on generations of historically biased data. Like, if we go back to the 1930s, government agencies literally drew red lines on maps around neighborhoods where minority populations lived, declaring them, quote-unquote, hazardous for investment.
Wow.
Yeah. And that legacy of redlining starved entire communities of capital for generations. So when the early credit scoring algorithms were built in the late 20th century, they looked at that historical data to learn what a good borrower looked like.
So they were essentially training on a history of exclusion.
They were, exactly. And relying on this old math, it mathematically hides prejudice. It makes it invisible to the naked eye.
Because it's just numbers.
Right, an algorithm today might not explicitly ask for your race on an application, but it uses what data scientists call biased proxies.
Okay, bias proxies. Like what?
So a proxy is a seemingly neutral data point, like your zip code or the length of time at your current address, that secretly acts as a stand-in for race or gender because of that historical segregation we just talked about.
Oh, I see.
By relying on those deeply entrenched historical patterns and a tiny handful of variables, the legacy system essentially automates those prejudices anyway.
The real-world cost of that invisible prejudice is just staggering. I mean, the source text points to a 2020 study by Citigroup.
Oh yeah, that study is mind-blowing.
Right. They looked at the economic toll of this exclusion, specifically racial inequality, driven largely by a lack of lending to Black entrepreneurs. Their estimate is that this exclusion cost the U.S. economy $16 trillion over a 20-year period.
$16 trillion. I mean, that is money not circulate, businesses not built, wealth not transferred to the next generation. It is a massive structural failure of the financial system.
And lenders knew the system was flawed. It wasn't like a total secret.
No, not at all.
But the traditional attempt to fix it actually created a massive headache for the banks. Like, if a zip code or a specific proxy is causing the bias, why couldn't they just delete that column from the spreadsheet?
Well, for a long time, the industry standard for fixing a biased algorithmic model was exactly that. It's a method called leave one out testing.
Okay.
You just remove a variable like income or a specific type of existing debt, and you run the model again to see if fairness is restored.
Seems simple enough.
You'd think so, but when you're dealing with complex machine learning models, variables don't work in isolation. AI uncovers these incredibly hard-to-discern correlations among hundreds or thousands of data points. They're woven together in this highly complex mathematical web.
So if you pull one thread out of the web, what happens?
It triggers a cascade of errors throughout the entire model. Because the algorithm had weighed that specific variable heavily in its calculations, removing it suddenly makes the AI overvalue other, less reliable data points to compensate.
Oh, I see.
Yeah, you ruin the predictive accuracy. It forced financial institutions into this terrible false choice.
Hmm.
You can either have a highly accurate model that might be biased or a perfectly fair model that is completely terrible at predicting who will actually pay back a loan.
Which is just a recipe for regulatory violations on one side and losing a ton of money on the other.
Exactly.
But here's where it gets really interesting, because Zest AI realized you can't use primitive math to vet complex AI. You need a fundamentally new approach, and that approach is called adversarial debiasing.
It is just a brilliant piece of engineering. It essentially uses AI to fight AI.
Yeah, I was trying to visualize the mechanics of this while reading the source. Tell me if this analogy holds up, okay?
Okay, let's hear it.
Imagine a chef trying to bake a cake and a food critic trying to guess a secret, forbidden ingredient just by tasting it. The chef is what Zest AI calls the predictor AI.
Right.
Its only job is to analyze an applicant's financial data and predict if they are creditworthy. It just wants to bake the perfect cake.
That is a highly accurate way to look at it. And in that scenario, the food critic is the adversary AI.
Okay.
Its only job is to look at the predictor's decisions, like who got approved and who got denied, and attempt to guess the applicant's race, gender, or age based purely on those outcomes.
So the critic is basically tasting the cake, trying to detect that forbidden ingredient.
Exactly.
If the adversary AI can accurately guess that the predictor is, say, mostly denying loans to a specific minority group, what is the actual mechanism that fixes it? Like, does the system just shut down?
No, it introduces a mathematical penalty.
Right.
If the adversary guesses correctly, it knows the predictor is relying on those bias proxies we talked about earlier.
Okay.
So the system automatically penalizes the predictor's score.
Huh?
It forces the predictor to go back, adjust its internal mathematical weights, find different correlations in the data, and try again.
So the chef has to keep tweaking the recipe.
Yes, and this loop doesn't just happen once or twice. It runs millions of times. It's a high-speed game of cat and mouse.
Millions of times. Wow.
The predictor constantly tries to minimize its error in predicting loan defaults, while simultaneously trying to maximize the adversary's error in guessing demographics.
Millions of iterations until the predictor is perfectly accurate at identifying creditworthiness, but the demographics of the applicants are utterly unguessable by the adversary.
Exactly.
The food critic cannot taste the forbidden ingredient at all, but the cake still tastes perfect. The AI is actively unlearning historical bias.
It completely solves the false choice. You get a final model that is highly accurate for the bank and demonstrably fair for the consumer.
No, as I was reading through the mechanics of this cat and mouse game, I hit what felt like a logical wall.
Oh.
Yeah. To know if the adversary AI is successfully guessing an applicant's race, the system actually has to know the applicant's race to check its work. But isn't it entirely illegal for lenders to ask for your race on a credit card or auto loan application?
It is, yeah. The Equal Credit Opportunity Act, or ETOA, prohibits lenders from collecting data on applicants' race or gender outside of the mortgage context. You absolutely cannot ask for it.
So how does the adversary AI know if its guesses are actually correct?
They have to estimate it. Lenders are required by regulators to estimate their applicants' demographics when conducting fair lending analysis.
But wait, how do you estimate something that complex without just, stereotyping people all over again?
Well, that's the thing. For years, the industry standard was a tool called Bayesian Improved Surname Geocoding. It's known as BSG. It was developed by the Rand Corporation back in 2009.
2009 in tech years is basically the Stone Age.
Oh, absolutely.
How did BSG actually work?
It relied on two pieces of public data, your last name and your zip code.
Huh.
First, it checked census data to see the racial breakdown of people with your surname.
All right.
Then it checked the racial demographics of your zip code.
Okay.
And then combined those two probabilities to guess your race.
That seems incredibly flawed. Like, what if someone is a Hispanic woman who married a white man and took his surname and they live in a predominantly white neighborhood? BSG would completely misclassify her based on those two data points.
That is exactly the issue. BSG is notoriously inaccurate, particularly when it comes to diverse neighborhoods, multi-generational households, or people who share common surnames across different ethnicities.
Right.
What's fascinating here is that you cannot fix what you cannot accurately measure. If your yardstick is broken, your entire fair lending analysis is going to be fundamentally flawed. The adversary AI would literally be training on bad data.
Right, so Zest AI had to build a better yardstick before they could even play the cat and mouse game.
Exactly.
They created the Zest Race Predictor, or ZRP. It's a machine learning algorithm that estimates race and ethnicity, still using just a full name and a home address, but applying far more sophisticated modern AI to find the nuanced patterns BSG was missing.
The improvements are highly significant.
Yeah.
When they tested the Zest Race Predictor against the old BSG standard, the numbers were incredibly clear.
Yeah, the stats in the source really jump out. The Zest Race Predictor correctly identifies African Americans 25% more often than the old 2000 buying tool.
Which is huge.
It misidentifies African Americans as non-African American 35% less often, and it misidentifies white individuals as non-white 60% less often.
It is a vastly superior measurement tool. But here's the crucial part of this story. Zest AI didn't keep this better yardstick a proprietary secret. They open-sourced the ZRP.
Wait, they gave the underlying code away for free.
They did. They provided the entire lending ecosystem, and were including their own direct competitors and government regulators in that, with a better tool to enforce fair lending rules. It elevates the baseline ability of the entire financial industry to identify unfair outcomes.
The math sounds great in a lab setting, right? You have better demographic measurement, you have this AI cat and mouse game scrubbing the algorithms, but I have to push back a bit here.
Go for it.
Because the traditional bank mindset is that if you make lending fairer by letting more people in, you are inherently taking on more risk. You are lowering the bar. So does fairer just mean riskier in the real world?
That is the ultimate question for any financial institution. And the answer, based on the data, is no. Because we need to look back at the 15-pixel photograph analogy.
Okay.
Zest AI isn't using 15 variables to make these decisions. They're utilizing hundreds, sometimes thousands, of variables to provide what the source calls a high-definition 3D view of a borrower's risk profile.
So instead of 15 pixels, you're getting like an IMAX movie of their financial reliability.
Precisely.
What are those extra hundreds of variables actually looking at?
They're looking at cash flow patterns, utility bill payments, consistent rent history, mobile phone payment streaks, things that the legacy FICO system completely ignores. And that high-definition view allows lenders to safely approve what the industry calls thin-file borrowers.
A thin-file borrower being someone who just doesn't have a long history of debt.
Correct. Think of a recent immigrant who makes $100,000 a year and pays all their bills on time but has no U.S. credit score, or a young person straight out of college. Or a divorcee who never had credit cards in their own name. Legacy models automatically flag them as high risk simply because they are invisible to the old mathematical system. But the AI model can see their actual financial behavior.
The real-world proof of this is in the client averages. I mean, Zest AI has over 180 financial institutions using this tech. On average, across all those clients, lenders see a 25% increase in loan approvals.
Yep.
And they see that 25% increase while holding risk constant. They aren't losing more money to defaults.
And when you look at the breakdown of who is getting those new approvals, the impact of removing that historical bias is undeniable. Approvals across protected classes jump an average of 40%.
I want to read the specific demographic jumps from the source because they are just staggering. According to Zest's client averages, approvals for Latino applicants go up by 49%. Black applicants see a 41% increase.
Approvals for women increase by 40%. Elderly applicants go up by 36%. And API, so Asian American and Pacific Islander applicants, they see a 31% increase.
I have to stop you there because when I read those stats in the source, I immediately looked for the catch.
Of course.
Look at Verity Credit Union in Washington State. Since they implemented this, their approval rates for Black Americans skyrocketed by 177%, and approvals for AAPI applicants increased by 375%. My immediate thought as a skeptic is, they must be taking on a massive amount of risky loans to hit those numbers.
It is a totally natural skepticism, but it fundamentally misunderstands what the AI is doing. It goes back to the difference between the 15-pixel photo and the IMAX movie.
Okay.
The legacy system was rejecting those applicants, not because they were actually risky, but because the legacy system couldn't see them clearly.
Yeah.
The AI isn't lowering the standards, it is dramatically increasing the accuracy of the assessment.
We can actually look at First Hawaiian Bank as a perfect example of that accuracy.
Right.
They serve a highly diverse population. They use Zest AI to increase their automated decisioning, meaning the AI instantly approving the loan without a human loan officer having to manually review it.
Right.
They took that from 4% of loans up to 55%.
And the performance of those automated loans is the critical data point. The accounts approved with the Zest AI scores outperformed their manual, human-reviewed exception accounts by a factor of 4x on delinquency.
4 times better.
The AI was 4 times better at predicting who would actually pay them back than the human overrides.
It completely shatters the old paradigm that fairness equals charity or bad business. As quoted in the source from Zest AI CEO Mike DeVere, this technology allows lenders to say yes to more people while taking the exact same amount of risk.
Exactly. And with approval rates for minorities skyrocketing without adding financial risk to the balance sheets, this raises an important question about oversight. How are government regulators reacting to this shift? Because historically, regulators are, 10 steps behind the technology.
Right. But we are actually seeing regulators adapt quite aggressively here. In March 2023, the Consumer Financial Protection Bureau, the CFPB, essentially laid down the law on algorithmic fairness.
They did. They issued a mandate emphasizing that lenders must actively search for what they call less discriminatory alternatives, or LDAs,
Yeah.
as a mandatory part of their compliance testing.
Well, what does that actually mean in practice for a bank? Like, what is an LDA?
It means you can't just run a biased model, shrug your shoulders, and say, well, it's just what the math says.
Ah.
You have to actively prove to the regulators that you mathematically search for an alternative algorithm that achieves the same business goal, which is predicting risk, but discriminates less across protected classes.
And in direct response to that CFPB mandate, Zest AI launched a tool called FairBoost. How does FairBoost actually help a bank find these less discriminatory alternatives?
FairBoost essentially automates that search. Instead of a data science team spending months manually tweaking variables to find an alternative, FairBoost runs hundreds of parallel models simultaneously. It automatically adjusts the mathematical weights, leaning into the adversarial debiasing we discussed, to present the lender with a menu of models. It allows financial institutions to seamlessly select the model that maintains their required profit margins while minimizing disparate impact.
So it turns the pursuit of equal access to credit into an ongoing automated operational priority rather than just like a static compliance checklist they look at once a year before an audit.
If we connect this to the bigger picture, it means that ethical AI is no longer a luxury for these institutions. It is the mandatory foundation of modern lending. By combining that cat-and-mouse game of adversarial debiasing with hundreds of variables, banks can safely approve diverse, thin-file applicants and crush compliance standards with tools like FairBoost.
So what does this all mean? We've gone from a pixelated 15-variable blind spot that cost the economy $16 trillion over 3 decades to an AI-driven, high-definition view of human potential. It's engineering fairness directly into the blueprint of financial access. But this completely changes how I view machine learning in general. It makes me wonder, where else could we use this?
It is a profound thought to leave on. If we can successfully engineer historical systemic bias out of a machine learning algorithm, using this adversarial debiasing, what happens when we unleash this exact same AI method on other deeply biased human systems?
Right.
Think about healthcare diagnostics, where historical data often ignores symptoms specific to women or minorities, or even criminal justice risk assessments and sentencing. For so long, we have worried about AI learning our worst traits. But if AI can be engineered to actively unlearn our prejudices, maybe we're building the very teachers that will finally show us how to do the same.
We started this deep dive talking about a 15-pixel photograph, blurry, incomplete, and heavily biased by the past. It seems like, for the first time, AI might finally be giving us the tools to see the full, high-definition picture of each other. Think about that next time you apply for a loan.